Hello and welcome to Wednesday's edition of Forecasts here on Dukascopy TV. I'm Kiri Bloor and today I'll be taking a look at the euro-sterling pair, where the overall outlook in terms of recovery seems bearish, and in particular today the pound is looking even stronger. On the line I have Ian Stannard, Executive Director and Head of European FX Strategy for Morgan Stanley, to talk to us through his forecasts. Hello Ian, and thank you for joining me. Welcome. Germany has been driving the euro for some time, but the latest economy sentiment is worse than expected. How do you see this affecting your 12-month forecast of 0.77, which places the euro decidedly lower than it currently sits?
Yes, I think the dynamics within the Eurozone are changing with regards to the driver for the euro. We have seen recently that the euro has become increasingly correlated to the performance of peripheral asset markets within the Eurozone, and with many of the inflows which have been supporting the euro in recent months heading into peripheral asset markets as the recovery in that region has gained some momentum. So overall, we think that the euro has been supported by that particular flow. But as we see, the ECB is becoming under increasing pressure to take further action to ease policy as we see deflationary pressure continuing to build. So on that basis, we expect the euro to start to lose some momentum as market expectations for some action, maybe as early as the June meeting, continues to build. We believe that a interest rate cut with regards to the refi rate, and maybe even the deposit rate, taking the deposit rate negative, could put the euro under some further pressure and lead to a broader decline on the euro, not just against the dollar, but on many of the crosses as well.
Does the inflation report released earlier today support your current 3-month prediction of 0.84?
For sterling, I think the picture is very interesting at the moment. Sterling has been gaining ground on the back of increasing rate expectations, which is obviously contrasted with the developments within the Eurozone. But at the moment, I believe that the Bank of England will continue to signal a very dovish stance, and that they are going to continue to try and send the message that a rate increase is something for 2015 rather than 2014. So I think there is likely to be some disappointment with regards to the market if the market continues to look for an earlier rate hike from the Bank of England. And today's labour market data was very interesting as well. Labour market data has been improving recently, which has gone a long way to fuel the market expectations with regards to interest rates in the UK. But today's data shows that the average earnings data was not quite as strong as the market was anticipating, and within the new guidance framework laid out by the Bank of England, where they're assessing the overall slack in the economy and the slack in the labour market in particular, this will suggest that there is still some slack there, and that the Bank of England can maintain a more dovish stance for the time being, which is likely to put sterling under some further pressure in the near term, particularly given that market expectations have become quite bullish on sterling, and long position has reached some quite extreme levels, so there could be some position unwinding in the near term. So that could allow euro sterling to rebound in the near term, but ultimately we'll be looking for euro sterling to come back under pressure as we head into the end of the year and into 2015.
And finally, the pound is getting stronger and the British economy is recovering better than expected, with unemployment figures much stronger than the Eurozone unemployment rate. What effect has this had on your 1-month prediction of 0.85?
The labour market data in the UK, the most recent numbers, I think, are consistent with sterling coming under some further near-term pressure, given that they have come in slightly disappointing, especially as far as the average earnings data are concerned. This is the market focus at the moment, given the Bank of England's new guidance policy, where they are assessing the relative slack in the economy, and the earnings data provides a very good barometer to the overall level of slack in the labour market. So this slightly disappointing number we've seen today does point to slack remaining in the labour market, which suggests that the Bank of England will maintain its dovish stance. That suggests that sterling could come under some further pressure, and that could allow euro sterling to move higher in the near term, even if the ECB looks set to take some further action in the months ahead.
Thank you, Ian, once again for joining us. That's all for today's forecast. Make sure you stay tuned for more from Dukascopy TV.